Welcome back to Switzer on Sky News Money. Now, recently in the Australian newspaper, Roger Montgomery gave old-fashioned blue-chip stocks a real right bollocking. I then responded in the Switzer Super Report questioning the validity of his advice to some investors, especially self-managed super fund ones, who are really looking for a reliable income stream. So tonight, I'm going to let Roger have his comeback. So let the debate begin. How are you, mate? I was really surprised you didn't email me, because you often respond when you get negative stuff, written
I didn't think it was that negative. I think what your...
A fair comment, was it?
No, what your comment... What you and I focused on very different things, I think. Where the differentiator comes is currently, and I don't know how convincing I can be to change your view, but currently...
I'm always open to intelligent points of view, you know that.
Well, currently, when I read your arguments, what I get from that is that people who are older, for want of, or more mature, and looking for income should focus on those traditional blue chip companies because they're reliable dividend payers and they've got a good yield. So that's one argument. The problem I have with it, and the article that I wrote in The Australian, was around the fact that there's a basic arithmetic, irrefutable argument to say that the maximum return you're going to get when a company pays out 100% of its earnings as a dividend is the dividend yield. If you buy and sell the shares on the same PE ratio, the maximum return is the dividend yield. Why? Because the company is not retaining any of its profits to grow its equity base. So what we're interested in are companies that can grow their equity base, maintain the return on equity on that growing equity base, and grow both their value and their income. The only way, using your approach, that we can make a better return than the dividend yield over the long run, and you might be happy with 7%, which is your argument.
Yes, my argument.
Okay. Yeah. But that's the maximum you're going to get, and the only way you can get more than that is if you successfully speculate that the PE ratio or the popularity of the company's earnings is going to go up.
Yeah.
So people comment, about sell in May and go away. They talk about Santa rallies. They talk about all this stuff, which I don't think has any merit in the ammunition of a value investor. So really, what we want to do is buy businesses that can not only grow their capital value, and these are what you say I call growth companies, growers, that are, and you said that they're risky. Now, I believe they're less risky over time because they're more likely to maintain or grow your purchasing power because they can grow not only the capital value but the income. Classic example, one example, CSL 10 years ago versus Telstra 10 years ago.
Yeah.
So Telstra 10 years ago, in 2005, under Sol Trujillo, was paying 100% of its earnings out as a dividend. Sol wanted to support the share price and boost his own, long-term incentives. CSL, on the other hand, was actually paying about 80% out, retaining about 20%. Now, the yield on Telstra was 5.97%. The yield on CSL was only about 4%. Okay, so you're earning more in 2005 on your Telstra shares.
Yep.
Fast forward a decade to the end of December 2015, your $100,000 in Telstra, which generated $5,970 of income, has grown to about $117,000, give or take a couple of $100. And your $5,900 has grown, that's the income, has grown to $6,500 because the dividend went from 28 cents to about 30 cents. Now, that dividend growth hasn't kept up with inflation. So you're actually poorer, despite having a more attractive dividend yield at the start, you're actually poorer from a purchasing power perspective at the end than you were at the beginning. CSL, on the other hand, which generated roughly the same return on equity but was able to compound and grow the equity base, the 100,000 has grown to $1 million, so you've had a tenfold increase in your capital value, but more importantly, that $4,000 of income has grown to about $19,000 of income. So you're now on a 19% yield.
Yes, and it's a very good point. But the challenge for the people out there is picking CSL and getting it right.
And
CSL was a public service business that's become a great
I used to
performer.
deliver newspapers to CSL when I was a kid.
But there are a whole lot of crappy high-flying companies that now disappeared.
But the difference is we're not...
Babcock and Brown, ABC Learning... And
we've not bought any of those.
No, of course not. I'm saying... And that's why I go back to... Because, for example, I use the example of CBA. It goes low, like $27 during the GFC.
Yeah.
So if people want to take my safe old blue chips, always buy them during a recession.
And I remember driving out of this studio during the GFC, talking to the ABC and saying, these banks aren't going broke, and yet they're being treated the same as a US bank, which is being bailed out and nationalised.
Correct, yeah.
So we agree that the CBA is an excellent example of the sort of businesses that we look for. In fact, we've owned CBA and we own it currently. But the NAB, on the other hand, is not CBA. So the result of homeside lending, you know, under Don Argus, they bought homeside. They lost $4 billion this year. They've crystallised that. You know, there was Clydesdale Bank. They lost $1 billion there. And so as a result of these forays overseas, when they reinvested capital, they lost money. They didn't make high rates of return on the reinvested capital. So the share price of NAB is lower than where it was 16 years ago. But CBA is a multiple of where it was. So what I'm saying is buy the true blue chips. And the true blue chips in that basket, or example, CSL tick, CBA tick, NAB not a tick, AMP not a tick, Telstra probably not a tick, because guess what? Its profit today, the first half result for 2016, its EBIT, NPAT and earnings per share is exactly where it was in 2006, 10 years earlier. It hasn't grown.
So, but I maintain this, and often when I talk to my clients, I say, well, look, you know, it depends what you want. You know, if you want to shoot for great gains, you might invest with someone like Roger Montgomery, because
but that's not what we're shooting for.
No. But you do want to do better than 5 or 7%. Otherwise, why should they even take a risk with you?
And yeah, so we've done closer to 16%. You know, and we've done that though. But let me make this point. We have captured, since inception of our funds, we've captured 97% of the upside movement in the market in any month where it's gone up, but only 47% of the downside.
Why else are you on the show? But the point I'm going to make is, Roger, if a GFC comes along, what happens to the dividend? I put $1 million in with you, right? And I need $70,000 a year. Hang on, let me finish up. So you need $70,000 a year. By putting together those blue chips, whether they be reliable or unreliable, you can get that 7%. You can get 70,000. With you, for 1 or 2 years, the income flow might be crappy. You'll rebound because they're good quality companies. And that was the point I was making. And my personal view is you should have a mix and match. You should have a core for your income and then seek growth with people like yourself or Jeff Wilson or whatever.
Okay, so we can refine and we can converge our positions by pointing out that, you know, in the case of Telstra, you know, it's a bond. It's like a bond, right, with not very much growth. It pays a coupon. Now there is an intrinsic value for a bond. There is an intrinsic value for that. And at the lows when it was at $2.65 or $2, it was cheap. And we
were tipping it on the show.
Correct. And you'd do very, very well. But buying it at $6 in March 2015, when it had a yield of 5.5 or 6%, fully franked, that wasn't an attractive thing to do, because it's going to mean revert, because there's no earnings growth. There's no growth in that. So I'm saying the same thing that you're saying, buy blue chip companies. But what I'm not saying is go for the highest yielder. I'm saying go for the one that's going to grow the income the most. No, because then you're going to be better off.
It's an absolutely correct assessment. But the bottom line I'm saying is that, and I think I made the point, there are different sorts of investors out there, and because term deposits are so terrible now, you kind of need... So let me make this point.
Last point. Okay, no worries. I actually think that irrespective, and this is maybe what we debate next time, but irrespective of whether you're 50 or 70, you can't make the stock market fit you. Ultimately, what you're doing is buying pieces of businesses, and it doesn't matter what your age is, you need to buy quality businesses with great prospects at a reasonable price.
Yeah, without a doubt. And the interesting thing is, as Buffett said, when everybody's greedy, that's the time to be fearful,
Correct.
and vice versa.
Indeed.
And a friend of mine who actually has always bought dividend stocks, and he's probably got a lot of the old blue chips there. He retired with $5 million in his super fund with an average yield of 10% because he buys during downturns.
Well, those sort of aphorisms, you know, they're helpful. You can't base an investment strategy on them. You still need to do the work. You still need to work out what are the economics of this business, are its prospects good, and is it cheap? You need to work out those three things.
No doubt. Well, what a delightful debate that was. So that's Roger Montgomery from... what do we call you?
Just the Montgomery Fund.
The Montgomery Fund. OK, Google will fix up the rest, I guess. OK, so that's Roger Montgomery. We'll be back with Rudy Philippek Van Dyke, and we're going to be looking about how we go and trade the market going forward with all those comments like sell in May and go away. Coming back.